Step into the fascinating realm of industrial metals, where steel prices fluctuate and market indicators are the pulse of an ever-evolving industry. Welcome to Cup of Joe, the metal podcast paying homage to our founder, Joseph T. Ryerson. Settle in, savor a cup of Joe, and let the conversation begin.
Like some technical difficulty to start the here. We had this great new intro and some glitch there. So hopefully some of that came through, Nick. I don't know. Were you able to see it?
Yeah, it did finally come through for me. But yeah, this is the downside of doing things live. But you know, you never know what you're going to get.
Yeah. So new year, new intro. Happy New Year, Nick.
Happy New Year. You have a good holiday?
I did. How about yourself?
Yeah, I had a great one. Can't complain at all.
I think we're still in the realm of being able to say Happy New Year. It's January 4th. And
I think so.
Yeah.
I think we're also in the realm of still being able to say that it was Cup of Joe that turned the Chicago Bears season around fully, because they've barely lost since they're the best team in sports right now.
You're right. It was Thursday night and maybe October. We had a Cup of Joe. You predicted maybe a big win that day, and then I think they've gone 6-2 since.
I think I did the reverse jinx by bringing up how bad they were.
Well, I mean, like I said, you should get a call. You should be involved in how they use that first round draft pick this year. So
totally agree.
Yeah.
Totally agree.
Oh God. Welcome to Cup of Joe for 2024. We've got an exciting agenda here today. We're going to go over some really unique information that I think we've been I think from we previewed this a little bit last episode where we showed some of the custom data that we've done, and I've asked Nick, hey, can we weave some of this into the macro stuff that you're talking about today? And looking forward to doing that. As a refresher, it's a customer survey that we did during November. We call it the metal perspective. We asked people about intention to purchase metal, fabrication, supply chain issues, even asked them about American manufacturing. Got a nearly 1,000 responses to that, so I think it's some substantial data, and we're gonna weave into that. We're gonna weave that into the discussion today. We're also gonna dig into that a little bit into what's on the screen here next month. That'll be part of Engage 2024. So before we get rolling, I want to mention that next, it just so happens that February 1st is the first Thursday of February. So that means we won't have a live Cup of Joe, but for not, we'll have a Cup of Joe segment within Engage. And hopefully
people
are familiar with Engage. It's this is the fourth year. Jason Pounders, our producer, will probably poke me if I said 3 before, but I think it's our 4th annual. Thank you for your conference. That's Jason right there. Our conference. We're gonna have Alan Polio. Did I pronounce that correctly this time?
You sure did.
Yeah, and we're gonna have our Cup of Joe segment. We're gonna have an expert on AI discussing that, manufacturing, additive, a lot of different trends. Registration's open. It's completely free. And we threw the link to register in the chat. So I hope you can join us. No Cup of Joe live, but Cup of Joe will be embedded in Engage. It's where Cup of Joe started, right? 4 years ago.
Right.
So yeah,
that's right.
Good stuff.
Big anniversary. And just one quick side plug for those who are in the Chicagoland area or may happen to be in the Chicagoland area here in about 2 weeks. I will be presenting on something somewhat similar to what we talked about in Cup of Joe and covering economic conditions and metals markets for the AWMI, which is the Association for Women in Metals, their economic summit. It's going to be on the 18th of January. That starts at 5:30 in the River North area. So for anybody who hasn't heard about that and you have interest in something like that or attending that, would love to meet in person. Hopefully that's colleagues and customers alike that can make it in attendance.
Awesome. Yeah, they always put on a good event. They're looking forward to hearing you speak there.
Excellent. So as we always do, we have to cover the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo. They are not the opinions of Ryerson. Do your own research. We think we've got some pretty cool content in here. As Mike had mentioned, we got, I think it was 950 to 1,000 respondents to the survey. So it's a pretty good broad swath of the American or perhaps North American pulse of how people are thinking about things for 2024. So should be a pretty good barometer. And then, as Mike had mentioned, we're going to pair that up or weave that into some supporting charts and supporting data that we'll talk about in context with those survey results. So we'll go ahead and hop into those here in just a few slides. But before we do, got to talk about one thing that changed fairly dramatically and kind of out of left field, at least in my opinion, since we last met on Cup of Joe. Up in the top left corner, or kind of in the left side, you'll see two different dates. The first one is a quote from Jay Powell on December 1st. And he said, I don't typically like to read, but these are very, very quick clips. He said, it would be premature to conclude with confidence that we've achieved a sufficiently restrictive stance, that's with regards to interest rates, or to speculate on when policy might ease. No, that's basically his way of saying we're going to keep rates higher for longer. As we've talked about in prior meetings, GDP continues to run strong, at least for now. Unemployment rates continue to be very, very tight, meaning a lot of people are employed, not a whole lot of layoffs. So up to this point, the market was basically saying the Fed's doing its job, but they kind of need to keep things restrictive for a little bit longer and kind of cool things off a little bit. Well, fast forward about 13 days, you get the second quote down in the bottom left corner, which is, quote, the reason you wouldn't want to wait to get to 2% with regards to inflation to cut rates is that policy would be too late, meaning they may accidentally turn into deflation and actually go negative on inflationary rates. Powell said on Wednesday at a post-meeting press conference, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So in about 13 days, he went from saying, we're going to stay restrictive, we're going to stay higher for longer, to saying, we might be overdoing this. Maybe we should start cutting interest rates here in the not too distant future. And I think we kind of alluded to this on the last Cup of Joe, but there already was an expectation that at some point early in 2024, there would be interest rate cuts. Some of that was on the back of, inflation rates coming down. Some of that's on the back of expectations that eventually we do actually get a softer economy, perhaps even a recession, and the Fed needs to turn more accommodative. But pretty fascinating how quickly and how dramatically his tone changed. And we're going to dive into a couple slides and try and figure out potentially why, or potentially what could explain that. But you look over on the right-hand side, this is a summary of all the different big banks around the world and their expectations of how many cuts may occur in just 2024. Some of these, if you go down near the bottom, UBS, they're expecting up to 275 basis points of cuts, which literally means that at every single meeting, essentially from here to the end of the year, the Fed not only cuts one time, they actually make multiple cuts in each meeting. That would be a pretty aggressive stance. And I guess in my opinion, something would probably have to be going wrong in order for the Fed to be cutting that aggressively. But you can see the general ranges. Most people are in consensus and believing that at least a couple cuts are going to be coming over the course of 2023. But the question is, why or how is that going to be achieved?
Most of these, sorry, can you go back? Most of these, the published dates you have on the right, most of them came after the 13th, right? So are you saying that's when they published what they think their cuts are going to be?
Those forecasts, that's correct. So they're pretty fresh with regards to the new data that Jay Powell has given them, which is he's becoming a little more dovish, a little more accommodative.
Yeah. I was going to say, is that reactionary to what's being said there? And I mean, does it possibly speak to some fundamentals, like maybe the economy's in bad shape? I don't know.
There's certainly speculation of, is Jay Powell seeing something that we aren't seeing? Because right now we've got GDP growth running at 2.5%. And we've got that here in a slide in a couple, but there was a lot of confusion around it because it was kind of, well, what's changed in 2 weeks? The GDP growth is still running pretty strong. There isn't really a reason that we can tell right now, at least that I can see publicly, that's really reason for panic that says we have to start, panic cutting interest rates. But with that said, let's go ahead and hop into a couple of things that could explain a little bit of it. The first being CPI data, which the latest data is continuing to trend lower, both on core CPI, so that's excluding energy and food. And then we've got core PCE, which is the personal consumption expenditures. Both of them are very clearly heading back down towards the Fed's target of 2%. But I would argue we're still pretty exceptionally high. I've gone all the way back to 2010 on this chart. And really, at no point in time, other than the last couple of years, have we even seen the current rates of inflation over that time period. So I still am of the opinion that a bit more needs to be done in order to be restrictive on the economy, get prices back down to earth. Now, that's not really what the Fed had said. So, but it is a little bit of good news. It's good news that we're trending the right way. Maybe we need a few more months of CPI data and inflation data to get back down to that range. But I would say we're not quite there yet. The other thing is we look at the Atlanta Fed GDP Now index. We're not only not trending down, we're actually trending up as we sit here today and we think about Q1 2024. The Atlanta Fed GDP Now index, what it's doing is taking the latest economic data, throwing it into a model and saying, if we were to freeze it as of right now, where does GDP sit for Q1? Right now it's 2.5%, which is a pretty darn good number. It's not quite what we had seen earlier in the year when we were running up near 5-6%, which is just gangbusters. But 2.5% is a pretty good growth rate, and certainly way off from being any type of recessionary indicator. So again, it's a little bit of a head scratcher because it says it doesn't look like there's anything to panic about for the Fed to say we need to be more accommodative. This is one potential element of speculation out in the market, which is this is looking at going all the way back to 2009 to current. This is the federal interest expense. So this is the interest expense that the federal government has to pay on its own debt that it continues to build. We've talked about this in prior Cup of Joes, but the current Fed balance sheet, I believe it just hit $34 trillion a couple of days ago, which is obviously a very large number. And when you apply that 34 trillion times the weighted average of what their interest rate risk is, their interest expense currently is tracking about $981 billion. That's almost $1 trillion. And the scary thing is this is only as of September. So that was when this data was last refreshed. So when you think about $981 billion, and that just being to cover interest expense, that number is roughly as large as the entire U.S. defense budget. And it's a function of two things. It's a function of one, just the general size of the Fed's balance sheet, which as I said, is 34 trillion and growing. And then the other is where are interest rates? And as interest rates have gone up and up and up over the last couple of years, they've gone from basically 0% to 5.5% on a spot basis. Not only are you growing the whole pie of the debt, you're also growing the burden or the rate of interest that they have to pay on that growing debt bubble. So this may be a reason why somebody may be knocking on Jay Powell's door and saying, hey, this interest expense is getting a little out of control. It's becoming a pretty major part of what the federal government's spending money on. Hey, Jay, maybe start bringing rates back down. Now, Jay may be pushing back behind the scenes and saying, well, we don't yet have inflation to where our goal is. Somebody on the other side may say, well, don't care, figure it out. So this is all speculation, but it is a potential explainer for why Jay Powell and the Federal Reserve broadly could be wanting to take their foot off the gas a little bit with regards to interest rates, despite the fact that inflation is still running pretty hot, in my opinion. Now, the one big risk that exists if we think about the Fed being a little premature on taking its foot off the gas, what we're looking at here, this is going way back in time, so a little bit of a history lesson. This is looking at CPI in the white line going all the way back to 1966 and running CPI through 1982. So this would have been the time frame when we were seeing, as my analyst so politely asked last week when he was talking about the very high inflationary environment and how interest rates ultimately had to go to cool that inflation. This would have been the time period where you were seeing 15%, 20% mortgages and 10 to 15% interest rates to cool off inflation. If you look at this white line and you overlay the current inflation data over the last several years, you can see the peaks and the valleys kind of correlate a little bit. There's a bit of a concern that if we take a snapshot as of today, if the Fed says we've successfully beaten inflation and we are going to start taking interest rates back down, we want to create a soft landing, there is a risk that we could get a second wave of inflation. And that is, in fact, what was seen back in the late 1970s. And that would have been under a Fed president named Arthur Burns. And he's kind of synonymized with being a little too soft on inflation and not really putting inflation to bed. There is a potential that Jay Powell could be a repeat version of Arthur Burns. Fast forward a couple of years, eventually Paul Volcker comes into the Fed position, and he ends up being famed for being heavily restrictive on taking interest rates way higher than they had to go ultimately, and really kind of slammed the market still. But it was all in an effort to bring that second wave of inflation down. I don't know exactly how this next couple of years is going to play out, but I do want to at least highlight the potential that while history doesn't often repeat, it sometimes rhymes. And this pivot of Jay Powell when inflation is still running at 4%, which is on top of several years of 5 to 10% inflation over the last couple of years, we could reopen that can of worms of inflation actually picking back up again over the next couple of years. Now, with that said, we are going to hop in and transition into the Metal Perspective Survey. We've got a couple of these every few slides, and then I'll weave that in with some economic data. The first one we're going to touch on is our customers' perspective on the economic outlook over the next 6 months. Pretty interesting. About 45% of respondents were sitting in the neutral territory. 30% are pessimistic on the next 6 months, and about 25% are optimistic. So the smallest correspondent would be on the optimistic side. Kind of interesting when you compare this to the current PMI data, which I would say generally reflects that not just in the United States, but in most developed economies. If you look down here near the bottom of this table, second from the bottom, you'll see the developed markets. So this is taking Europe, the United States, Canada, many of these developed economies. You can see that we are seeing PMI data, which is the Purchasing Managers Index. Again, this is kind of doing a similar thing where it's actually taking a survey of purchasing people. That developed market PMI is continuing to soften a little bit, down at 47. Go back up to the top of this chart, you can see line by line which regions are contributing more to that. Canada is slipping a bit. They're down at 45.4. That's a fairly soft number, so it does look like Canada is outpacing a little bit to the downside in terms of cooling off a little bit. The United States is down at 47.9. So we did get at least per the S&P Global survey, we did get a little bit of I'd say a somewhat substantial move lower on the US PMI for the month of December. Now, switching over to Mexico, Mexico looks pretty okay. It's one of the few regions really in the world, or the main regions of the world, that is sitting in growth territory. And then lastly, looking at China, China's just kind of teetering either side of 50, and it really has been, as you can see, for the last 12 months. So nothing really exciting or downtrodden with regards to China at this point in time.
We were talking about this a little bit earlier today, Nick, right? Is that, we're considered to be in a manufacturing recession, if you will, or slowdown, right? But it hasn't seemed that bad. I say that where I know I'm pretty sensitive to that phrase, but I mean, when you look at the numbers, it could be a lot worse, right?
Yeah, it could be, and I would say, gut feel, at least in terms of being in the metals industry. And this can deviate depending on the end market a customer would be in, but there are some absolute bright spots, and we'll highlight those here in a few slides. There are some spots that are a bit cooler, but on the whole, it feels fine. It feels okay. But I think, one thing that we kind of centered back on after our discussion, and this was between 4 or 5 of us in the Ryerson headquarters, what we kind of landed on was, I think it's important to keep in mind that a lot of these PMI surveys are in fact that they are surveys, and it's a gut feel. And if people aren't feeling good, if that's because of inflation or because they're being told on the TV all the time that recession is coming, people may feel a little bit different than what reality is. And I think that can happen sometimes, whether you're looking at like consumer confidence data, consumer sentiment data. Sometimes people just don't feel all that good about their environment that they're in, whether that's because of politics or inflation or whatever it may be. But I do think we need to be at least a little cognizant of the fact that these are surveys, they are gut instincts, they aren't necessarily being ruled by hard data all the time, though we do have some data in here that is hard data.
The Russians, what is that, over the last 4 months? That seems very high for situation, right?
Yeah, and has continued to be so for the better part of a year at this point. we've talked about this one at length. I think there are a lot of question marks about whether or not what they're submitting is real. Again, keeping in mind that these are surveys. Surveys can be swayed if they've got a populace that wants to be supportive of whatever effort their country is working on. They could submit faulty data. I don't know if that's the case. But yeah, I mean, on the positive side, you flip over to India, Indonesia, those two market economies, they continue to just plug along at very solid growth rates. India, if we're not careful in the next couple of years, India is going to be one of the strongest markets out there in the globe, which is pretty impressive.
Yeah.
Next up on the metals perspective survey, we're looking at ranking of influential factors on metal purchasing decisions. And I'm not going to highlight all of these. I mainly just want to look at the big ones. So I'll first look at customer demand, which, as you can see, that's overwhelmingly the largest factor for why a purchasing manager would make a purchase decision. And I think that makes sense. You're flowing through thinking about what your customer ultimately needs. So let's take a slightly deeper dive into what the customer is ultimately demanding at this point in time. And the nice thing about the ISM survey is they actually break out some of these line items where we can look at things like new orders. We can look at things like customer inventories, backlogs, exports. Unfortunately, the data does look a little squishy right now. Again, I think it's worth noting these are surveys, but the new orders sitting at 47.1, that's year-over-year weakness, and it is trending a little bit lower versus the November data. So it's not just cooling, it's cooling at a faster rate. Customer inventories are depleting, so there is a little bit of destocking taking place. On the backlog of orders, they're a little bit more positive. They have swung higher in terms of the numerical value. So the pace of the decline is slowing, but it is still a decline. So I highlighted that one as a yellow or an orange because it is heading generally in a slightly improving direction, but it's not quite into growth territory. But you look down in the bottom right corner, Mike, you mentioned the idea of this manufacturing recession. This is one of the main items people are highlighting when they cite that. It's the fact that when we look at the Institute of Supply Management, which is generally deemed to be a pretty good barometer for the manufacturing economy, it's been in contraction for 14 months. Now, I always want to caveat this, and we actually talked about this earlier this morning. I want to caveat that by saying a lot of this is being compared to year-over-year data, and it is absolutely the case that things were running wild in 2021 and 2022. So in some ways, yeah, it makes sense that you can't always just run as hot as we were for that period of time. At some point, you have to have a little bit of a breather, a little bit of a reload, and perhaps that's what we're feeling right now. But the duration of that being 14 months long, it's a pretty long period of time and would normally be coinciding with recessionary type conditions. It just doesn't quite feel like the recessions that we've had in the past. And maybe that's an important thing to note, because 2020, the recession that we had, that was COVID. That was a weird one. That was hopefully a one-off for our lives. The one prior to that was 2008, 2009, which was not your garden variety recession. That was a bad one. And so who knows? Maybe we're just in some, more normal garden variety type slowdown where it's a couple percent declines, no big deal, a little bit of pain, you tighten your belts and you get through it. But it is interesting how negative and how long that duration has been. Next up, on the metals perspective, going to look at the impact of supply chain disruptions. So per our customer base, if you take the caused minor disruptions down the bottom in yellow, orange, and then the light blue area, which is moderately disrupted operations, along with the significantly increased operations. If you take a couple of these factors, basically 2/3 of the respondents are saying that supply chain disruptions did impact their business, did impact their ability to source product.
Yeah,
the good news we have here. Yeah, go ahead.
Yeah, sorry. And I was going to say, I guess when you look at that, right, I mean, a disruption is a disruption, whether it's significantly done so, moderately, minor, there's some kind of blip. That's what's my math does, right? Like 75% have experienced some kind of disruption. So, I mean, what could be minor is actually going to be, quite significant. So I think we could have very well just have said like who's been affected, who hasn't, right? And then you got that 2% that's not applicable. So
yeah, somehow
in the gray.
Yeah, it's quite curious how it would be not applicable, because I would say nearly every bit of the sun was impacted by these supply chain disruptions, and not just in the U.S., on a global basis. This is looking at the Federal Reserve supply chain pressure index. So it's basically looking at relative to normal times, relative to normal flows of goods and services around the world, how many standard deviations did we get away from the normal? And you can see typically this index ranges between -1 and 1. So, it explains a pretty decent portion of hiccups that can occur in a supply chain as we're moving goods around the world. We got way above 4 in terms of the pressure, which basically means that this happens 0.001 times over the course of our lifetimes. I mean, it's very rare instances, and it impacted nearly everything that you can imagine within supply chains. The good news is, as we fast forward to where we are now, the current data point of 0.11, it basically means that supply chains are back to normal. If we were wound just a couple months ago, it would have even been loose in terms of the supply chain disruptions, meaning there was an excess or an abundance of things available. We have reversed that a little bit, and I think that's something we might want to keep an eye on. And I'll show you why here in a second, because we don't want this trend to pick back up and become something that becomes another hiccup and an issue for prices and availability of goods. But something that I do want to make sure everybody's cognizant of is the fact that there is a potential risk that we could see some disruptions for those who are shipping goods internationally. What I'm highlighting here, this is a screenshot as of yesterday morning. This was taken by the energy analyst at Bloomberg. So he's a research analyst within Bloomberg. What this is showing is each one of these light blue arrows, it's showing the direction of the vessel as it's moving around. And it's also showing the relative location of all of these vessels as they're shipping goods around the world. Now, he did a very elementary job of circling this red area. I would have done a much better job, but I stole his work, so I had to utilize his circling. But what he's ultimately highlighting is the fact that, and many of you have probably seen this, there's been some growing tension, not just from the Israel-Hamas tensions, but also from the Houthi tensions within the Red Sea. So we don't know exactly who's involved, but there's speculation that perhaps Iran may be behind some of it. Some of the Middle Eastern nations may be behind some of this. But ultimately, what we want to focus on is it is impacting the flow of goods through the Red Sea and through the Suez Canal, which, as you can see, it's got a heavy proximity to oil-producing regions, things like Saudi Arabia, Oman. This is also a very heavy traffic terminal just for goods generally. My analyst Kevin pulled up the stat that 18% of goods that ship internationally typically go through this channel that is currently not being utilized. And it's not being utilized because there is military or aggressive conflict taking place where boats are being sank, boats are being shot down with drones and things like that. And insurance agents will not insure boats to go through there. So what you can see is, rather than taking the short route straight up through into Europe, into the Mediterranean Sea, boats are instead having to divert south, go along the southern tip of South Africa, and then head back north, come into either Europe or go to South America or to the United States. What does that do for goods and services? Well, one, the insurance is going to make it more expensive, just outright. The route that they have to take is going to add several days, if not weeks, to these trips for goods and services. So you would expect longer lead times, longer backlogs. And certainly the availability of shipping cargoes or containers is actually getting a little tight again. So some of those things we saw back in 2021, 2022, they're not back into that level of scarcity and that level of pricing, but they're moving that way fairly quickly. So we hope that this conflict doesn't last too much longer or doesn't escalate further, because it is causing supply chain disruptions, inflation of shipping goods, inflation of cargoes, and certainly higher insurance costs. And there's the obvious one of military conflict is never a good thing. But something I at least want to highlight.
You mentioned an elementary, circle there, but I'm going to ask an elementary question for customers. Is it, if they're heavy into imports, having, metal imported, is it going to be delayed finished parts? What's the What's the biggest impact we see
Yeah,
to customers?
great question. It's not elementary at all, and shame on me. I should have translated that into what that means for our customers. But yeah, for anybody who's operating with foreign supply chains, whether it's through China or Vietnam, really any of the regions over on the right side of this map, you can see that the route is getting lengthened and probably more expensive. So yeah, whether it's a finished part or whether it's a coil of steel, it's likely going to be a little more difficult to get. Trading companies may be less enthusiastic about taking that risk as well. And then I didn't mention this, but there is actually a little bit of an issue with the Panama Canal as well, where the Panama Canal is having issues with water levels being a little lower than what they typically are. So yeah, whether it's the Suez Canal, Panama Canal, some of these things that if they echo or sound like 2021 when you had the ship get jammed in the canal, I mean, some of these things are sort of bubbling up again, not to the same extent, but a lot of those hurdles that we saw, they are showing their ugly face again a little bit.
When our director of international procurement, Jeff Penns, would be proud of me for bringing up the low water tariffs and things like that, right? So
oh yes,
he's mentioned those on the past, right? Where you start getting all those crazy tariffs.
I hope he's tuning in right now. I'm sure he's giddy.
Shout out to Jeff.
On the metals perspective side, what impact have labor shortages had on metal fabrication efforts? The vast majority or the largest quadrant here would be a moderate impact with regards to labor shortages. We've talked about this at length. Similar to the supply chain bottlenecks, we certainly had issues where it was hard to get people into the manufacturing space, really at any cost, but certainly at any kind of cheap cost. The good news here, and so we've got some sprinklings of good news within this space, which is as inflation is coming down, as a little bit of the Fed interest rate hikes take hold, the good news of this is it should loosen up the employment picture a little bit. So what we're looking at here is going to be wage inflation in the blue line, which is shown on the right axis, and then the JOLTS job opening. So that's the number of jobs that are currently open and not filled, which peaked out around 12 million people, is currently down around 8.8. So it's come off pretty dramatically. What that means is it should be a little cheaper, at least with regards to the growth rate of wages, should be a little easier to find people to fill roles. So hopefully those employment related issues become less and less of a bottleneck. And a lot of this was actually purposeful with regards to the Fed, because one of the things that was kind of poking them in the side was wage inflation can sometimes be sticky as it relates to inflation. So they wanted to cool this off with increased interest rates.
If I could, sorry.
Yeah.
Could you go back to the actual results that we had? Yeah. I thought one interesting one here, the 4% that said adapted with automation. And, we've talked in the past about the role of AI or some different kind of automated systems. And it kind of speaks to your labor chart there. I just thought that was a very interesting one. And I think in future surveys, we might open it up to saying, what exactly does that mean, right? So you've had these shortages and it's had effect on your fabrication efforts, but I'd be interested to see just what the adapted with automation.
Yeah, I mean, I'm a little surprised, honestly, that the number is as low as 4 as we sit here today, just given all the things we've seen within, technological improvements with manufacturing and AI and anything relating to stats and computers. Maybe the reason why it's so low is just because our respondents looked at it over such a short period of time. My gut would say that number would grow fairly substantially in the coming years.
I hate to do another shameless plug for Engage, but that's going to be our one of our special topics, right? Is AI and additive, and how that's really influencing manufacturing, fabrication efforts, things like that, all the above. So we could probably dial into that a little bit more when we hit Engage.
Hey, shameless plug away, Mike.
Figured if you got your speaking engagement up front, we're going to get the other one here.
That's right. So looking at what are your plans for metal purchases over the next 6 months? Perhaps no surprise, but for the most part, customers are saying they're going to maintain metal purchases on a 2023 basis relative to 2024. So roughly flat. I think when we look, if we remember back what the PMIs looked like, plus or minus either side of 50, not real exciting one way or the other. I'd say that's roughly flatlining in terms of metals purchases, manufacturing activity. So I think it mostly makes sense. If we look at the other two items, slight increase year over year. which is a bit encouraging, actually, when we think about what that could imply for PMIs as we look into 2024. I would say on the whole, this looks slightly optimistic with regards to our customer base and how they're thinking about metal buying into 2024. And perhaps we shouldn't be overly surprised. I think this is a new chart for Cup of Joe. I created this over the last 30 or 45 days. But what we ultimately did was we looked at like durable goods data for a variety of different sub-indexes and sectors within the manufacturing space. It might be a little difficult to see some of the titles on these vertical bars, but I'll highlight a couple of them. What this is ultimately looking at is year-over-year growth, and I've divided it into, I think, 10 or 12 different sectors. Over on the left-hand side, these ones that are really, really growing at a rapid rate. Going left to right, you've got aircraft shipments, you have non-res construction machinery, HVAC, which is going to be heating, ventilation, air conditioning, mining and energy, electrical equipment. Now, I'll ignore the ones in the middle to spare everyone from reading all of them. Over on the far right-hand side, we've got ship and boat shipments, farm machinery shipments, industrial machinery, and then household appliances. The point of this slide is really to say, I think it jives pretty well with what our customer base is ultimately saying, where the majority, if we were to pick a majority on the increase versus decrease, there's a slightly heavier number saying that they're going to increase metal buys. When we look at this chart, I would say that does sync up. There are some industries that are actually running very well right now. Some of them may be beneficiaries of, some of them may be military potential spending. Some of them would be, let's say, federal spending with regards to the Inflation Reduction Act, a lot of the infrastructure bills that are taking place. Some of these could be beneficiaries of that, but nonetheless, this is growth and this is real metal usage. So when we take this chart and we kind of compare it to what the survey results said, I think it aligns pretty darn well, which is, yes, there are some industries that are seeing some tough times right now, and that may continue for another few months. But there are absolutely some bright spots within the manufacturing world as well. So it's kind of a tale of the haves and the have-nots as we look at it right now.
Yeah, and if we kind of sliced and diced that info, those responses a little bit. So if you recall, the first chart you showed was what's the sentiment for North American manufacturing over the next 6 months, and it was 30% that kind of had a negative outlook. We looked at the data for those 30% that had a negative outlook, and of those 30%, 61% were going to maintain their spending on metal, and 23 we're going to reduce. Now, then we took that 23% that was going to reduce, and it was because of they foresaw 60% of that saw customer demand as the big reason why, and prices was number two. So I think that what tells us is, like, even they have a kind of more of a I wouldn't say negative, but more
pessimistic,
withheld, right?
Yep.
View of the economy. They still know that metal matters, right? And they're gonna still push that in. So I thought that was
and it's an interesting summary for wrapping up on the macroeconomic side of things, which is that's kind of where we landed this morning when we were all talking about it, which was maybe people just feel crummy, but they're going to maintain the status quo and keep buying metal, and it's business as usual. It's okay to feel crummy, but at some point we have to respect or reflect the fact that metals matter, and metals are consistently being bought and utilized in the economy, and maybe we should cheer up a little bit.
yeah. No more Dr. Doom, Nick. Come on.
Right.
2024. Yeah.
And that's not to say that there aren't risks out there. As a risk manager, certainly want to make sure that we are respecting the risks that exist out there, and we do hope that we highlight a lot of those. But I do think there's a little bit of an undertone where people just feel a little exceptionally crappy relative to what the real conditions are, at least at the present time.
Great.
Now, lastly, I feel like this is a good segue into the metals commentary, which is ranking elements that may be related to the buying or utilization of fabricating metals parts. Uh-huh. The largest piece in this was material cost, and what we're going to highlight over the next couple slides is information over metal costs, most predominantly with regards to the commodity portion of these metals, but in a lot of cases with fabricated metal, the largest price driver is in fact the commodity. So this is what we're attempting to do here on Cup of Joe, is make sure all of you are informed on what our views and what the latest is with regards to commodity prices. So let's go ahead and dive into that. Hopefully we can be a little helpful. On the carbon side of things, it continues to be the case that the U.S. is the premium market with regards to demand and with regards to pricing. That's a bit of a good news, bad news situation, because as we sit here right now, U.S. prices are really more than double some other regions of the world. We're currently sitting right around $1,100 per short ton for hot roll. That's up from $650, so call it roughly $500, $450, $500 since late September, early October that we're up. So that's a pretty dramatic move. You can see in comparison to Europe, which is shown in the blue line, China, which is shown in the orange line, they've seen a little bit of inflation. They've seen a little bit of an inflection higher in prices, but their move is 10 or 15%. Here in the US, it's almost 100% in the last couple of months. So what's driving that? Well, one is certainly I think we can make the argument that the United States is a premium market with regards to how well we've held up relative to some other developed market economies. You look at Europe, for example, you think about those PMIs. That was the big sliver of red going straight through the screen. So things are pretty soft within Europe right now. I would argue very much so that they are looking like they are in recessionary territory. So it makes sense that their pricing would be at some semblance of a discount to ours. Other factors we've got going on is the U.S. mills, the steel mills, they are keeping production of steel relatively subdued. This is looking at the capacity utilization rate. So this is of the productive assets that are available here within America, what percentage are being utilized to make steel. And you can see that the latest number is 73.1, which is a pretty soft number, particularly when you consider the fact that steel prices are up $450, $500 in the last 3-4 months. I would have thought, and maybe the mills are just trying to prove me wrong, but I would have thought that in the face of $1,100 hot roll, we would see steel mills attempting to capitalize on that and become far more profitable by meeting the higher prices with more production. But we just aren't seeing that at this stage. So whether you call it artificial, whether you call it gamesmanship, whatever, or you just call it good business, the mills are being very responsible with how they are producing steel into this current market. So they're keeping things a little tighter than what many, I think, would have forecasted, given the fact that we have $1,100 steel. The other thing we've got, and unfortunately this data is a little stale because U.S. Census Bureau data tends to be very lagged. So the latest data that we have is as of October. But what we're looking at here is carbon imports of a variety of carbon products. You can see them color-coded down at the bottom. Ultimately, what the point of this is one of the big things that allowed domestic mills the opportunity to hike prices as many times as they did over the last several months. The market was tight. They were producing at a very low level, 73% utilization rates, and imports for the last several months have been very subdued. So that makes for a somewhat tight market potential, or I guess particularly when you consider the fact that I think there were a lot of service centers and end users that stockpiled material back in September, October, November to kind of try and get out ahead of the potential price move and to get out ahead of Q1, which is typically a seasonally strong time. So you had this combination of factors of low imports, low utilization rates, probably some stockpiling taking place, and that allowed for this storm to take place. If we fast forward on these import data points, I would suspect that as we roll into November, December, January, February import data, I'm going to guess that these bar charts move higher and higher and higher pretty quickly, because while imports were not attractive 3-4 months ago, back when these data sets would have been formed, the imports are advantaged at this present time with domestic pricing at $1,100. Imports are sure to be somewhat cheaper and potentially compelling to bring into the United States, so that people can have a mix of inventory that makes it a little bit cheaper.
The scenario you outlined earlier in the Red Sea counter that.
Yeah, I'd say it throws a small wrench into it. It would increase the cost of those imports slightly, I would argue. It could have a small impact on that for sure. And then lastly, the one thing that I didn't touch on was there is absolutely, and the mills will tell you this if you ask them, there is a raw material inflation that's taken place over the last couple months. The white line is going to be busheling scrap. It's gone from about, let's say, $400 up to $550. Price of iron ore has gone from about $100 to $140. So those are meaningful moves, without a doubt. Are they meaningful enough moves? Is scrap going from 400 to 550? Is that enough to substantiate steel going from 650 to 1100? No, not at all. Not in any world does that fully get substantiated. But when you factor that along with the fact that markets were exceptionally tight due to lower production levels, utilization rates, lower imports, and a bit of stockpiling, yeah, I think that creates the storm you can get. The issue that we may have as we roll through time, and this may look pretty familiar or similar to what we saw in 2023, there is a risk that this, and the market currently thinks that this party or this inflation of steel prices won't last all that long. You can see that in the shape of the futures curve, which is basically the market's expectation of where prices will go in the future. Otherwise, if it's wrong, you can buy these contracts. If you think it's too high, you can sell these contracts. So these are moving around every single day. This is just the snapshot as of last night's close. But you can see for the next 2 months, the market is basically saying they think prices will be elevated somewhere around 1100, maybe a little bit above 1100. But beyond that, at least as of today, the expectation is each month in time we roll forward, we may see $100-ish price moves lower as some of these factors correct themselves. And I would say you probably also get a little bit of a seasonal weaker time period beyond Q1. One thing that I didn't mention already is earlier this week, it is worth noting that Cliffs, they did do another price hike. So they took the base price of their carbon shipments up to $11.50 for their base pricing for hot roll. I haven't seen yet if any other mills have followed suit. Not that necessarily matters all that much, but it is worth noting, at least as an anecdote, that one mill thinks that the prices deserve to be a little higher than where they are right now, which is right around $1,100. Flipping over to aluminum, we are beginning to see a little bit of a perk up in aluminum, perhaps not for the reasons we would have thought. Sometimes markets surprise us and some wild things and sometimes some scary things happen. You can see just in the last couple of weeks, so the month of December, we did see about a 7-8% move higher in the price of LME ingot, which is going to feed into ultimately the price of common alloy aluminum pretty much directly. One of the main drivers of that is what's shown here, which is the price of alumina. So similar to the way in which we could use iron ore to make steel, we can make aluminum using alumina. Alumina is a byproduct or is made from bauxite. Basically, those are the two very raw ingredients. Bauxite's coming out of the ground, getting refined into alumina. Alumina is being used to produce some aluminum. What happened was two things. In the last 30 days or so, there was a curtailment of production of alumina within China. Some of that was due to environmental and regulatory issues, so they had to mothball some production of alumina. The other item, which is a sadder incident, was there was a pretty major explosion that took place at a bauxite facility in Guinea. And Guinea is a very large producer of bauxite, which again is a raw ingredient going into aluminum production. Those two factors, they basically tighten up the market, perhaps only for a short period of time, but they've certainly tightened up the market in the short term. It may not look like a whole lot because of all the volatility we've seen over the last 5 years in alumina prices, but make no mistake, some of these moves in China, I think the aluminum move is like 25%. In Australia, it's moving about 10% just in the last couple of weeks. So that is meaningful, and that is kind of a cost push mechanism to LME aluminum prices. And traders have taken note. You can see that this is looking at the commitment of traders report, which measures how bullish or bearish the financial community is. You can see that up until early December, they were somewhat bearish on the metal, meaning they held short positions, and that's denoted by the white line. That's basically your neutral territory. Just in the last couple of weeks, they have moved into marginal bullish territory on the back of a couple of these factors, mostly related to the raw ingredients on making aluminum. Lastly, on the stainless side, I don't have a whole lot new to report, but it is kind of a continuation of the same. The good news for our customers is it likely means continuation of lower stainless steel surcharges. What we're looking at here is a 5-year chart of LME nickel. And as we sit here right now, we are almost smack dab on the 52-week lows. So right around $7.30. You compare that to where we would have been back in 2022 when we had the crazy short squeeze. Prices went to $25 a pound. We're in very different days now. And the main driver for this is that we have much more nickel, primarily class 1 nickel, coming to market. And this is only one way to look at it, but this is looking at the London Metal Exchange inventory data. Finally, we are beginning to see this narrative that we've talked about on Cup of Joe for the last, probably 5-6 months. We've been talking about the fact that Indonesia is ramping up production of really all grades of nickel, but mainly class 1 nickel is being produced in a much more rapid fashion. And it will be continually over the course of 2024. The other thing that we mentioned is the London Metal Exchange has been doing a fast track program to allow for more grades of class 1 nickel to be put on the exchange. And it looks like that's beginning to play out. Whether we like it or not, more and more class 1 nickel is moving on to the exchange, which at the very least, it signifies to the market that, hey, the market is no longer running out of class 1 units. We are getting not just growth, we're actually getting it looks like exponential growth in the volume of nickel that's hitting these exchanges. And I would say, if nothing else, that's symbolic of the fact that this nickel that's getting produced is finding a home on these exchanges. And perhaps one step further, the fact that it's finding a place on the exchanges rather than, in stainless steel may be an indicator that end markets are still kind of weak and it's not being consumed just yet. It's rather being put into a warehouse. So not exactly the most bullish of scenarios. We tend to still think that there are going to be some headwinds through most of 2024, barring one big change in our eyes, in my eyes, which is Indonesia may at some point, if nickel prices keep going down and down and down, there is a potential price at which they may say, we aren't making the money we thought we were going to make. We have to shut in production. If that's the case, the narrative does change a bit and we could see some price support, but we haven't seen a whole lot of that just yet.
Looking at some of the data as we prepared, our market report from January of last year to this year, the surcharge for both 304 and 316 have dropped a little over 50% each. So, I mean, that's substantial. And nickel's a component of that, right? And then obviously it's chrome and moly. Do you see what's the status of those two commodities?
Yeah, so I don't have a chart on molybdenum, but I'll speak to it. We did see some tightness. A lot of that was due to South American production issues with regards to copper and molybdenum, which are kind of byproducts of one another. When you mine for one, you get the other product as well. So this South American production issue is causing tightness in molybdenum. Prices went up to about $25 per pound. We started to creep lower and continue to creep lower. It seems like every month. We're right now sitting, give or take a few cents, probably about $17.25, $17.50. So it's come off pretty substantially. And then the price of chrome, which I do have, this is not the official index that goes into the North American stainless surcharges. But what this is it's kind of, I think I've spoken to this before in the past, but this is a South African chrome index, which is where most of the chrome in the world comes from at the present time. So it tends to be a good barometer of directional intra-quarter price moves. As I look at this, comparing October to current, it's basically forecasting to me, we may see a little bit of softness, mostly sideways, but maybe 4 or 5% softness in the price of chrome on a quarter-over-quarter basis. So if I'm making bets for Q2 and we don't have the data just yet, I would suspect we're probably going to see the chrome index settle somewhere around 145 to 150 is my guess. And right now it's 153. So we'll have to wait another couple weeks to get the official number, but that's where my bits of data are currently suggesting.
And while we're on this, one of our avid watchers, Scott, has asked a question. Hello, Scott. About this. We talked about Indonesia. That's been a big narrative around nickel over the last year, as has this potential for a new exchange, and he's asking, has everything that's been occurring, has that kind of quelled these shouts for a new exchange?
I'd say so. Yeah, I mean, short answer is I'd say yes. I would say it does seem as though the London Metal Exchange is finally learning from some of their pitfalls, which was not enough brands being accepted of producers of Class 1 metal, not a lot of transparency into where that metal is coming from. I think they've taken some steps to help loosen up those or loosen up the transparency and make it more transparent. And the other thing that I do think the price controls on disallowing prices to move more than 15% a day has helped to stem some of those fears. So it took a while, and it seemed like they were doing everything wrong, and you had a lot of fraud that took place over the last 18, 24 months with regards to nickel or things they thought was nickel being rocks. The hope is those things are behind us. And yeah, I would say that that's kind of pushed the need for a secondary exchange or a secondary index to the back burner, which honestly, at this point, the domestic mills, the domestic stainless mills, maybe are wishing for a secondary index, because all the LME market keeps doing is going down, down, down. So it's not a lovely scenario in the short term for the stainless mills, because they just continue to see their prices of stainless go down as well. But this too shall pass at some point. At some point, we will find an area where it won't make sense for some producers to keep producing. I don't think we're quite there yet. And it doesn't seem like there's quite enough pain at the miner level or the producer level, but we could get there in the not too distant future.
We're getting some questions on stainless, and Nick, forgive me, I don't know if you're able to answer this, or this might be better for one of our product managers. They're asking about the price of the 300 series stainless in North America versus Europe. That might be better suited for one of our product managers, would you say?
Yeah, I don't have the exact dynamics on that. I mean, just anecdotally on North American 300 series product, I would say that year over year we are expecting marginal softness in the base pricing. How that compares to Europe exactly, I don't have that data handy. But so I would defer to a product manager on that one.
Yeah, and I should note, if your question's in the queue and we can't get to it, we'll try to follow up. So Mike, someone who's asked that question, will make sure to follow up on that one. Someone wants a slide on the Cotton Bowl. That might be a sore subject for you.
I think I'm going to have a tumor later in life over that game. That might have been one of the worst Ohio State games I've seen in my life.
People know your affinity for Ohio State, so at least that's what's come out of this. As a side note, I must admit, when I logged on and I saw that score, I was like, man, this is the team that was fighting for national championship a few years ago. All right, we'll move on.
Thanks, Mike.
The Red Sea. Back to that. Someone's saying that they're being told by some shippers to expect 30% increases in costs and upwards of 4-week delays. I don't know if we're hearing any types of numbers, but it's kind of what you alluded to, right? That, we'll probably expect some of those delays, time and costs constraints.
Yeah, absolutely. I think, whether it's a cost factor, whether it's a timing factor, the simple math is it just takes a ton more time to go south through or below South Africa than it does going through the Mediterranean Sea, and that's why it's had traditionally been used. Mm-hmm. And the other factor is, insurers, as we understand it, even if a shipper wants to move a ship through there, their insurance provider will not insure it. So it's a financial disaster if they go through that area and get a ship shot down. If they're that unfortunate one, they may not be able to recoup any of those losses. So it's a little extra time. It's certainly not an ideal situation for supply chains or for costs, but there are workarounds, which is the good news, but it just takes a little bit extra time.
Yeah, makes sense. There's a question here about carbon plate. Are we seeing any, from what I recall, the price has increased a little bit over the past month, I guess. What, particularly non-strip mill plate, do we know anything, what's going on in that world?
Yeah, it still remains elevated. And I would say with carbon sheet prices up at $1,100, it's kind of closed the gap to where plate prices are. So for now, I would say it's mostly sideways, a little bit higher versus the last time we all spoke. Probably like $1,350 to $1,400 a short ton is where I'd put that number. So yeah, it's basically plateaued out, but I would say a lot of that's due to the fact that carbon sheet prices moved up to where plate prices were.
Makes sense. Yep. And finally, it's a big topic. We talked about it a few months back with Brian Crane about U.S. steel sale. Nippon, is that how you
Yep.
pronounce? Has won that out. I guess any surprises there or implications in the market on that front?
It seems like there's going to be a lot more to the story. I mean, I don't want to dive too deep into it because it does seem like it actually does get fairly political, involves unions in a very heavy way, and I just don't have any edge or insider intel that would say which direction a political framework or a union framework would go on that.
Makes sense.
If I would only say my personal opinion, if it ends up being a Japanese producer, we do have other foreign producers of steel in North America already. So I don't see it as a national security risk personally. I think Japanese operators produce very good steel, and I think it would be, I don't see the issues that some others do, but that's just a personal opinion. I get that there's a lot more to it than that.
Right. Well, before this is where I'm going to ask you for closing thoughts. But before I do that, I'm going to ask the audience here in the chat. There's two links I want you to check out. The first is register for Engage. It's on February 1st. It's at engage.tv. That's ENGAUGE.tv. And then we also put a link in there for a complete write-up on our survey results, the metal perspective that we went through. So if you want to dive deeper into those charts and some others, that link is there. We'll also send it out with our follow-up email from here. They did a great job of weaving that into the macro data, and I think it helps paint a picture, and it seems to be aligned with what's going on in the market. So that's good. Meaning our data.
Well, I mean, that's the thing that I think is so cool about it. I don't know how many respondents go into the S&P Global survey. I don't know how many go into the ISM survey. But 950 respondents is a pretty meaningful pulse on the market. So I guess my question for you, Mike, is there any chance we would do this again in like 3 or 6 months? Because I think it's actually a good product to continually revisit, because it does give a good pulse of what we're seeing, what our customers are seeing. And I think it's real valid data. And I think, it helps to really round out some of the macro data that we already discussed, and maybe embolden a lot of that data as well and make it more relevant.
Yeah, absolutely. That's the plan, actually, to do kind of a mid-year and then end of the year. We did this years back, and went away from the last 2 years, just basic thing, but bringing it back, that's what we did. We did it twice a year. We're going to do that. But yeah, you're right. It's a good pulse. And then once we get to about the midway point, I think it'll be a good way to then compare this data to that. So yeah, we're definitely planning on doing so. So I'd kick it to you. We'll see the audience for an abbreviated cup of Joe during Engage, but for the next full episode is not till March. So what do you want to leave people with between now and March?
Yeah, no, I don't have a ton of takeaways. I really wish everybody a happy New Year, and hope everybody has a great business conditions and a very fruitful year in 2024. Let's kick it off strong. It certainly looks like Q1 is going to be a pretty decent quarter, and then we'll see beyond that. But stick with us on Cup of Joe. We'll keep throwing the information at you, and we're going to hopefully bring in some new charts and some new data, and keep it very fresh as we roll into Engage. And I think our other guest speakers are going to be great as well. So we're going to have a ton of fun, and hope to meet some of you or many of you at the AWMI event here in 2 weeks as well. So thank you.
And I promise to not start so choppy next time, and have our intro music hammered in there. So
Can only improve.
That's right. Thanks, everyone.
See you.